Good morning, everyone, and thank you for joining us for another Kansas City Regional Outlook discussion. What a great day to be having this conversation, and to be honest with you, as much as we've been doing these over the last year plus, this is probably the one I'm looking most forward to. For a couple of reasons. One, we've got a returning guest with us that's going to be able to revisit the economic outlook for the entire region that we discussed about 1 year ago today. And now our forward-looking perspective is coming from a completely different situation. Before we were probably much greater uncertainty. The uncertainty hasn't left us, but optimism has certainly increased. And there's good reasons for optimism. Aside from opening day today, businesses are opening up, and I think by the beginning of next week, at least in Missouri, vaccine eligibility is going to be sitting there for the entire population. So we've got a lot of reasons to be optimistic overall, and I can certainly see this moment having an end to it, and then understanding what have we done over the last 12 months from our different industries and from the overall market, and then what is the perspective going forward. It's always important to get some industry expertise in that, and we've certainly got that today. As we begin, I wanted to go ahead and start in with a couple of housekeeping items. At the bottom of your audience console, there are multiple application icons for your use during the program today. And if you have any questions during the webcast, please submit them via the question box. We'll try to answer all questions during the webcast today, but if a fuller answer is needed or we run out of time, it will work to get that answer via email later. In addition to that, a PDF of the presentation is available in the resource folder. You'll see those presentations today, and the program has been approved for legal education hours. So for those of you that applies to report your hours, click on the CEU icon at the bottom of the screen, and a certificate of attendance, including course numbers, will be emailed to you tomorrow, along with a recording of the webcast for watching and sharing. Toward the end of the program today, be sure to complete our short survey. We use your feedback to plan future programs that are applicable to your business needs, and we certainly do work to adjust and tailor our focus and our panelists tied to that feedback we get from you on those survey questions. So please take a moment to do that. That's all for the housekeeping items, and we can get started with the program today. As I was mentioning, about a year ago, we had Jason Brown with the Federal Reserve Bank speak to us on the historical context of where we were in an economic moment. And then we also got some great insight about the industry perspective over that 12 to 18 month cycle from an outlook view. And today we're going to get a revisiting with Jason, and then some great input on from a development perspective, as far as how the last year has gone and what expectations there may be on a going forward basis, and also from a financing perspective as well. So we've got three great speakers. I want to get started with each of them, and then as we get towards the end, we'll have time for questions. So as you hear the presentations today, like I said earlier, if you have questions, please go ahead and send those. Our first speaker is Jason Brown, Research and Policy Officer for the Economic Research Department of the Federal Reserve Bank of Kansas City. And in his role, he coordinates the regional and commodities research for the bank and serves as liaison to regional and commodities researchers located in branch offices throughout the Kansas City region. And largely, Jason is a representative for us of the broader economic outlook that we rely on the Federal Reserve to source for us. And so as much as I appreciate all the information that institution provides, it's even better to have someone who's got their fingers on that, being able to give us some perspective from a historical context and then regionally today and going forward. And so very excited to have Jason be our first speaker. And with that, thank you and welcome. And Jason, I'll turn it over to you to start.
Okay, thank you very much. Thank you, everyone, for participating, and thank you, Charles, for inviting me back. It's going to be my pleasure to talk with you about the U.S. and regional economic outlook. As a reminder, these will be my views and not the views of the Federal Reserve Bank of Kansas City or the Federal Reserve System. So let's start with the outlook themes. These are the things I hope that you'll take away as the main points. Although we've seen employment remain well below pre-pandemic levels, economic output has largely recovered. Having said that, absent stronger employment gains going forward, we do think spending growth will remain dependent upon ongoing fiscal stimulus. And though uncertainties remain, as Charles alluded to, there is reason to be optimistic that a self-sustaining recovery will take hold as vaccinations progress. So let's talk about where have we been this past year. So this first slide I have for you shows essentially the dramatic drop in payroll employment on the left and nominal GDP on the right. And so you can see we're still about 6.5% below where employment was at its prior peak, while output is only about 1.2% below where it was last year. So again, a completely unprecedented drop in overall economic activity in order to try to slow down the path of this virus. What's helped fill part of that gap, particularly on the output side? There's lots of details here. I'm not going to go through all of them. I would encourage you, you can go back and look at the slides later. But really, I want to give you a sense of the amount of fiscal policy support that we've seen. Close to $5 trillion over the last three bills, including the most recent one at $1.9 trillion. Now, the stimulus checks are obviously the thing that gets a lot of media attention. You can see it's the 1.9, or it's the 422 billion teal box on the far right stack there. But there is also sizable support in unemployment insurance, as well as state and local spending. But still, $5 trillion, very large amount of fiscal support to try to fill that hole, so to speak, in economic output. I mentioned employment, though, right? And so one of the maybe brighter spots for Kansas City right now is our employment situation is maybe not as dire. So this chart looks at the level of payroll employment, and it's indexed to February of 2020. So if you look left of February 2020, you can see that leading up to that, employment was steadily rising. And then we get the national emergency last spring, the stay-home orders go in place, and we have this dramatic drop in overall employment. So in the U.S., we lost, close to 12% of employment there. In our region, in Kansas City, and then in Kansas overall, we didn't come down as far, and we've kind of come back up about similar pace. But you can notice in Kansas City in particular, we're still about 4% below where we were, but that's certainly in a slightly better position compared to Kansas and the nation as a whole. So what sectors are doing maybe a little bit better right now? Well, this looks at payroll employment on a year-over-year basis. So compares February of this year to February of last year. And I've sorted these so you can see the sectors that are growing the fastest, or in this case, have less of a decline from top to bottom. And then over on the right portion of the chart is the share of that sector's Kansas City jobs. And so you can see transportation, utilities, and federal government are actually up a little year over year. But notice we have all these sectors that are still down quite a bit. And in particular, leisure and hospitality, not too surprising, down almost 19% still compared to a year ago. And that makes about 9% of the jobs in Kansas City metro area. So a lot of sectors are obviously struggling with respect to employment, but leisure and hospitality is one that definitely kind of stands out even more from the crowd. And that makes a lot of sense as we think about people's travel behavior over the past year. I want to turn to consumer spending. This chart shows some real-time indicators of consumer spending. These are honestly data we didn't have a year ago. And so we're very glad to have this resource. It's from Opportunity Insights, Track the Recovery. And so it measures spending relative to beginning of the first couple months of 2020. And you can see, again, we had this dramatic decline in spending. But then as these stimulus payments start to roll out in last spring, we see some recovery. And then we're basically been flat. But then when we get another stimulus payment kind of at the end of 2020, we see consumer spending rise again and then kind of fall back down again. Of course, right now we're waiting for that next round of stimulus to work its way through. So all that's to say, consumer spending has responded to these stimulus payments, but you can see after a while it works its way through and consumer spending kind of levels off again. On the small business side of things, we do see revenue remaining about 20 to 30% below pre-pandemic levels. So again, this is small business revenue indexed to the levels at the beginning of 2020. And you can see, again, the dramatic decline last year at close to 50% in the U.S., about 45% in Kansas and Missouri. But small businesses largely are still relatively struggling. You can see it's been more kind of sideways, although more recently maybe there's been some improvement. But with revenue overall being down 20 to 30%, that still is a substantial decline. A little bit more worrisome and something we're trying to follow more closely is the number of small businesses that remain open. So again, indexed to the level of where they were at the beginning of 2020, you can see everyone kind of shut down because they had to. But you can see kind of slowly over time that this percentage is drifting down again. So that's kind of suggesting that there is some scarring that's taking place. And it could represent small businesses that aren't honestly just going to be able to open up again, unfortunately. One bright spot, though, throughout this time period has been residential construction in particular. This is the value of permits put in place. The gray shading represents the current recession we're in. And notice that in both Kansas and Missouri, the value of permits put in place has actually been increasing over the time frame. I don't have a slide for it today, but you probably have also seen that house price appreciation has also been increasing. So again, residential construction in particular is one bright spot that we can point to. So in summary, measures to slow the spread of COVID in the spring of 2020 has led to an unprecedented drop in output. While output has largely recovered, we see improvement in the labor market has been more sluggish. We do see service-based sectors such as leisure and hospitality have been amongst the hardest hit. And overall, consumer spending is above year-ago levels in the region and nationally. While activities up in manufacturing, service, and construction, some small businesses are still struggling. So with that, I'm going to end here, Charles, and turn it over to you.
Thanks, Jason. That's great. And that is there's a lot of encouraging signs there, and you can certainly see where we have still a little ways to go, obviously. One of the positive signs, I think, and hopefully we'll hear a little bit about that today, is one of the strengths I kind of think of the Kansas City region is Kansas City builds the country. Between the construction, the design, the engineering firms, and in particular, some strong developer skills that are not just significant in our market, but nationwide as well, are a great indicator of what gives us some solid footing. And as in relation to that, one of the best development firms that our community gets the chance to host is Van Trust. And with us today is Grant Harrison, the Director of Development for Van Trust, whose primary responsibilities include identification, evaluation, and execution of build-to-suit and speculative development opportunities for Van Trust. Grant has been with the company since 2006, and in addition to that, part of that time during the early stages pursuing and obtaining a finance degree from Oklahoma State, and some prior work experience with PNC Bank as well. So Grant, both in his just background and perspective and in the role of leading Van Trust over this period of time, is going to be able to give us a perspective on how they've been tackling this last year, what they see going forward, and hopefully will bolster some of the positive indications that we just heard from Jason. So with that, Grant, I want to turn it over to you, and thank you for joining us today.
Thank you, Charles. Really appreciate the opportunity, and hello to everybody virtually. As Charles mentioned, Van Trust is based out of Kansas City. We do have 4 additional regional offices and have a lot of good projects going across the country. So a pretty good pulse on the market. But just like everybody else last year, the wind was knocked out of us, and we had to pause, reset, and figure out, what the path forward was. We had a lot of different projects, whether under construction or various stages of lease up, that we had to get our arms around pretty quickly. Now, luckily for us, that pause was maybe 2-3 weeks. And we looked down pretty quickly thanks to industrial and office pursuits and projects that kept going. Again, construction was deemed essential. We were able to really kind of blow and go and plow through last year. Again, silly to say, but very fortunate. We had one of the best years we've had in terms of construction starts, not only in Kansas City, but across the country. So the big debate, is office dead? Where are we going? We very well could be wrong. We hope we're not, but we think office is here to stay. It will evolve, and over the next 12 to 18 months, it's going to be really interesting to see what really happens and who occupies what space and where. Through a mixture of bad timing and good luck, we delivered a spec office project in Frisco, Texas last spring, and luckily quickly leased it and stabilized through the early stages of COVID. There was a clear flight to quality. There was a large list of companies who still sought after brand new product, Class A modern space, and space that wasn't restrained by prior tenant improvements. So they had flexibility on how they designed their space for their employees and their company. That allowed us to go spec again next door on a 3rd building in Frisco, which we will be delivering here in about 4 weeks. Again, great initial leasing activity and interest, and really confirms our theory that there is still an office need, at least in select markets. But there will clearly be a flight to quality. Another really good example is a project we are delivering in Tampa. So this is right on the Tampa airport's ground. It will be the nicest and probably biggest building Van Trust has been a part of over the last 10 years. But high quality, Class A, great amenities, great space. And again, we're seeing that flight to quality for all types of people, big and small, all different industries. So very optimistic. And although there's no Kansas City renderings or photos here, we're just a little early, but we are touching 5 projects in Kansas City. I wish this panel was 6 months down the road and we could actually talk about them. But same thing, great design, construction, great flexibility. There's going to be a flight to quality in modern space, more so than ever before, to attract and retrain folks. No question, there will be people working from home efficiently and by choice. But we think there'll be a good mix of people going back, whether full-time or hybrid models, 1 to 3 days a week. So again, the need for space, we believe, is here in Kansas City and across the country. We're going to take our chances developing new space, whether spec or build-to-suit, and are a little hesitant and afraid of what could happen with tired Class B, C space. But will be interesting to see what happens over the next 6 to 12 months. So a much easier topic and kind of the darling of commercial real estate is the industrial sector. As everybody knew, e-commerce was coming and here for a lot of consumers, but COVID lockdowns and restrictions more than likely pushed adoption forward 5 to 7 years and overnight. We consider COVID now kind of the great accelerator in the industrial world. and we don't think that's going to go away anytime soon. We all expect and favor convenience, choice, reliability, and all within the hour. And to meet those expectations, we saw a frenzy of leasing and new development across the country. And those folks who had a presence online only doubled down, and those businesses and folks who did not have an online presence, I think, scrambled to retool their model and kind of jump in to keep up. So all over Van for us, we're very bullish on industrial really across the country, and we believe there's a great runway going forward. We're obviously in some very robust and active markets, but Kansas City is right up towards the top of that list. We have always been a great logistics hub with our central location, access to rail, labor, and great infrastructure, but COVID really accelerated that climb. We are now a top 20 market, both in net absorption and growth rate, and have delivered nearly 40 million square feet as a city since 2012. This year, as a city, we'll deliver close to 10 million square feet of new construction fueled by build-to-suit and speculative development, which will shatter all records. And that's backed by great absorption, really for the foreseeable future. And it's not just e-commerce, it's really a little bit everybody, 3PLs, food and beverage, cold storage. It's just everyone catching up and learning from what we went through this past 12 months. So the positives for us really on the industrial sector, not only here in Kansas City, but across the country, there's evidence of steady demand and need, significant interest from buyers and investors, continued and almost scary cap rate compression. And for the foreseeable future, we would think there's a low interest rate environment for borrowing. Now, with the positives, there are negatives. There is a potential for oversupply. There's incredible competition. Non-traditional developers and owners are jumping into the industrial arena daily. There's land prices that are soaring, labor constraints, and one of the hottest topics right now is the increased construction prices and lead times, such as steel and precast, which are now the toilet paper of last spring. We're fighting over it, and it's almost tripled in price overnight. Now, with all that rambling, again, we're really bullish on the office and industrial sectors, specifically in Kansas City. We've had a great run, really the 10 years leading up to COVID, and we think we're going to jump right back in, hopefully this second half of the year and for the foreseeable future. So excited to be part of the community and developing here. That's all I got, Charles.
Thanks, Grant. That's great, and I appreciate the focus on both of those sectors as well. And so I think we'll have some questions to circle back that has got implications on both as we get towards the second half of our discussion. But before we do that, so we've had a chance to hear from the overall economic perspective and the folks that are on the ground doing the work with the investment. The capital investment and finance support is always key, and it becomes more and more important when you're in what is, I don't think uncertainty is the right word as much anymore as highly fluctuating. You look at the difference from where we were pre-COVID, the different type of expectations we had going in, and now understanding where movement is and has not been. So couldn't think of a better person to help give us some discussion on the overall financing markets than Adam Kilpatrick, the Director of Commercial Real Estate in the Kansas City market for Enterprise Bank since January of 2017. And just as an example, since that time, they've grown their real estate portfolio by over 200%. And Adam himself has been involved in almost $1 billion in real estate investment and loans during his career as a lender. And so, one of the things we try to do is get a handle on where are we in the context of some historical perspective. And so that's where experience, having going through some ups and downs, really makes a difference when you're trying to understand what the finance markets will look going forward, which is always a key for us. So I'm very happy to have Adam be the third speaker for us today. And with that, Adam, welcome, and please go ahead and kick off the discussion.
Great. Thanks, Charles. Appreciate it. Glad to be here. Certainly an interesting time to talk about the state of banking. 2020 and even now into 2021 has brought on a lot of different strategies for banks. You have banks that really completely shut down. You had some that ignored it completely, and then you had really the myriad of in between. The banking industry as a whole was saddled with administrating the ever-changing PPP program, which ate up a vast amount of resources in order to push those dollars out. In 2020 and really now carrying into 2021, we're grappling with a lot of noise in the market. There's a lot of, we still have a ton of people still working from home. How does the transition back into office work? Our sales cycles are still disrupted because of that. And it's really been hard to tell what's real from an asset performance standpoint, just because of the massive amount of spending that Jason mentioned that's been in the market. So we have this enormous cash buildup where we're seeing it at all-time lows and sizable amount of cash just on the sidelines looking to invest and needing to invest. So you have this need to deploy the capital, and you have a large number of projects that were delayed or deferred, but all from 2020 are pushing forward at the same time, as well as we do think interest rates for currently are low, but I think there's fear that they will rise along with inflation. So you have projects that are increasing their timelines to try and deploy now. So you have all this demand, and it's the fear is, are we creating bubbles across asset types? I think that's one of the things that we look at in banking. And I'm sure as investors, everyone is as well. What's the real value of these things, long term, and if there is a bubble, which side of the equation is going to get hurt on that. So something that we are thinking about a lot. Sorry, I didn't move my slide over. So. Here we go. It is quite the conundrum because we have this major increase in demand, which is making it hard to find new deals. It's making it much tougher to get assets purchased. And there's just a lot of competition in the market to buy assets, which is driving down cap rates. But at the same time, top line revenues have not really increased as the cap rates have decreased. So there's more equity, which kind of goes back to the bubble. Now, is that equity at risk? Are the rents going to drive, further as cap rates go down? Remains to be seen. But we do feel like there is a lot of movement. We're overloading the system as far as new deals standpoint goes. If you've tried to get a new deal over the line in the last quarter, you find that appraisers are their turn times instead of 21 days or 30 days, and title companies are overloaded, attorneys are overloaded, bankers are overloaded. Just seems like it's really hard to push things through. You couple that with supply chain issues, as Grant said, lumber and steel are going through the roof. Construction costs are going through the roof, not only labor, but materials. So as an industry, I think we're looking really hard at how we mitigate that. You look at adding to contingency. I think if you've got a project in any form of pre-construction, you need to go back and really look at your contingency number. We're really wanting to lock down a lot of those contracts and subs as far ahead of the game as you can. And also we're looking at increasing our construction timelines. It's going to take longer because there's going to be some variability as a lot of those materials are available. So it's tough. It's tough to find deals. It's tough to get deals across the line. But there is some real optimism, as we've said, that, there hopefully is some light at the end of the tunnel. And we've got data on how how companies and assets were able to perform last year. So we have more information to kind of be able to build an underwriting against and forecast into 2021 on. So that's really helpful for our underwriting. The demand that I discussed and the somewhat slower 2020, just because of project stalling, we were competing against cash buildup. People were paying cash for a lot of things. And then, the massive PPP effort diverted a lot of the production resources for banks. And so you have banks that really, really need to and want to deploy quality dollars into quality assets. And you've got investors who, have cash and have identified real estate as a, predictable return source. So specifically in multifamily and industrial. So you do have this good opportunity for a lot of projects to move forward. It's just kind of fighting through the weeds to get them done. I think we've talked a lot already about Kansas City and its strong position. As Jason said, our jobs didn't dip as far. They came back quicker. I think we have a great deal of potential to have a stronger job growth in the country moving forward. A lot of that is highlighted by the industrial logistics hub that Kansas City has really turned into. We're seeing a lot in housing, single family and multifamily continue and are going to continue to be a big need. We've got a unique way to bring office back. And that'll be interesting to see. I think we think that, there is going to be a continued need for office, and it'll be interesting to see how that plays out. So all in all, we have a lot of really strong drivers in Kansas City. We're excited about 2021 and in the future and CRE lending.
Thanks, Adam. That's great. I appreciate that. And each of you have added some perspective that generates a few questions, and I think maybe the first one, which I'll ask a little bit of Jason and then Adam, it picks up of what Grant has said. So there's this concept that one of the things that has happened during this time is some trends have just that were in place before have really sped up. And one of those probably is the push to e-commerce, which clearly, there's some merit to that with our industrial investment, but at the same time, there's some intuitive impact on small business in particular. I tend to think of small business, so retail, restaurants, and the like kind of pop up the most. And that's been a significant part of the Kansas City economy. So, Jason, I think the first question for you on the pinch that the small businesses are seeing that you identified is, if you could explain a little bit about how what kind of falls in that category and how big of an impact is that on the Kansas City economy, particularly on where some of those job losses are. And then Adam, when Jason's done, if you could talk about, just from a lending perspective, what type of, what your outlook is on the lending opportunities in the small business environment. I think I'd like to get a little bit of perspective from both of you on that.
Sure, Charles. Yeah, I really honestly couldn't say it better than what Grant pointed out. Structural change in the economy is really being accelerated right now. In general, we see that to be the case whenever we have a recession. This recession obviously is a bit different in nature in that it, was really as a result of trying to slow the pandemic. But it's true, more commerce is going towards e-commerce. Brick and mortar retail continues to struggle, although brick and mortar retail is also trying to increase their e-commerce base. And if you're a small business, you probably have had to also develop further your online presence over the past year. And if you haven't, then you're probably really struggling, and you're struggling more. I would honestly say, and the charts I showed, as it relates to small business revenue and small business closures, there is probably a sizable chunk that are in restaurants or in bars. And so, we know some of the challenges that those sectors in particular faced over the past year. And yes, they ramped up curbside ordering, those sorts of things. But I don't think it's fully offset the lost revenue. And I'm just thinking personally, normally I would be doing this event in person, or if we're doing it virtually from my office, right off of Memorial Drive right there. And, I've only gone down the office like 3 times since last March. And so any additional spending that people would spend down in Kansas City, as an example, after work, that's essentially gone. That's out the window. So I think small businesses have to increase their online space, their presence, and then hopefully they're doing a little bit better. But absent of that, this structural change that's kind of working its way through, businesses were going to have to adapt, or they're going to be gone, unfortunately.
Thanks, Jason. And Adam, from a lender perspective, there's, even going into this COVID experience, we've always had a kind of a long discussion in our community just about access to capital, support for startups, and the like. So I'm just wondering what, from a lender perspective, how's your outlook there, and what are the unique things you have to deal with?
Yeah, I'll take it from the kind of, real estate lending perspective. We really, we've said this already, this has been an accelerator. We were shifting towards this anyway. I can't remember the last junior box deal that I looked at that was even viable, or that anyone even really wanted to build. So, we've been moving towards online and really experiential neighborhood retail for the last several years. I still think, there's a huge pent-up demand for people to go to restaurants and movies and really, anything of the like. So, we've really been focused from a, retail development around those kind of neighborhood centers that have your grocery anchored stores that, really that's going to be tough to buy online. Without having to go pick it up. So we think grocery is going to stay. And then, it's been tough, but you still have to get your hair cut. You still have all those service industries that can kind of support around that. It's been really interesting to see how innovative a lot of these companies have been to work through this. And, I think if they can hang on, a little bit longer, when we are at the end of this, that stuff's going to come back in a very large way.
Thanks, Adam. I appreciate that. And Grant, shifting over to the, particularly the office discussion that you had raised, again, on an outlook basis. I kind of think of the office building that I'm in, not today, hadn't been for a little while, right? But it's largely anchored by a few professional service firms, and that presence kind of provides a lot of support for the small businesses that are around there. And so there's some placemaking that takes that happens with office locations. Clearly, as much as I think we've, to Jason's point, been able to adapt to technology needs, being in the same space with folks makes a difference. And I think that's becoming more and more obvious. So I think from an office perspective, one of the questions that I haven't seen the slides you've raised is, are there site selection criteria? Are there other unique aspects that have become more important to you as you identify where the right investment is from a location or commitments? What are the unique things that are, one, making you continue to be optimistic about office, and are you kind of factoring in some different priorities than you had before?
Sure. And, every office project, or better yet, any multifamily project, you want amenities, you want great locations, you want all that good stuff. Now we have to hit every single box. You got to have walkability, structured parking, retail, green space, sustainable features. We're really ripping up the old model and reevaluating what we build, especially if it's brand new construction, and better yet on a speculative basis. We have to be so flexible for these companies and employees as they start coming back. Because again, we're optimistic, but we haven't seen anybody, but for one example, come back and occupy the space. We need to see how they live in it when we're truly back to normal, when we all feel safe. But to your point, we're across the street from your office. I think we're one of 12 floors occupied right now. Good or bad, we own the retail down Main Street. It's struggling, right? We don't have the people in the office space coming to town, coming to different parts of town and shopping. So it's all interconnected, and hopefully we come back and we can play off each other a little bit better. So.
Well, I appreciate that, and I think that kind of almost just supports the priorities and trends get fast forwarded a little bit. And I think that I like the flight to quality perspective that you've stated. And I think that helps from an understanding standpoint. So Jason, you did a very helpful job this time and last, given a little historical perspective. And I think from all of the discussions that I have had for the Kansas City market now, there's a lot of reflection back to the 08-09 fiscal crisis and just understanding how that impacted the Kansas City region. And maybe the most common one is it was we got hit a little after the coast, right? And it came in and it was maybe not as bad as a ride down and not as steep as a ride up. And so I think one question is, as you see the amount of federal investment, the rapid nature that things are starting to open up and spring back, are you expecting that there will still be a longer ramp up relative to what we see from a national perspective for our market? Or does that still hold true from your perspective, that it's a slower, less volatile up and down for us?
Yeah, it's definitely true in our region, not just in Kansas City, but I mean, really as we look in the 10th Federal Reserve District, which is the 7-state area that the Kansas City Fed is responsible for looking at. The broader region just tends to not enter the recessions at the same time. If you think about, in this particular case, the case of the pandemic, our population density is lower, and so therefore the spread of the virus was initially slower. We didn't have to use maybe as aggressive initial policies to really clamp things down like was chosen in some of these very large cities where you got people, stacked on top of people. And so that's, I think, the primary reason why we didn't see as large of a decline. To your point, though, I think what it means is, we're not going to necessarily from here have very, rapid growth kind of snapping back, right? We didn't have as much of a drawdown. And so therefore, we're going to normalize and probably not expect to see necessarily faster growth. But it really all kind of hinges in the stimulus bills that are in play right now. To be honest, I find it very hard to keep up on what all they're kind of piling into that. I think, there's another talk of a potential infrastructure bill coming. Whether that will happen or not, I honestly don't know. And there's lots of things that could come into play that could be positive, but also honestly add more fuel to the fire around labor shortages or material costs, shifts in energy right now that are being considered from more towards more renewables. So those are things in the energy space that could potentially increase the profile growth in our region a little bit more to the nation, but we have to just kind of see what the specifics end up being there.
Thanks, Jason. And Grant, we talked a little a bit ago just about the this whole concept that Kansas City plays a role in building the country, just the, like your company being sourced here and undertaking projects in a number of different markets, which you've touched on. So I think it'd be interesting to hear for the audience, are there markets that you have started to look at stronger? What's your overall perspective on the national market? What are you seeing going on out there in different regions that are going to continue to keep you guys busy?
Sure. And yeah, we're as one of a handful of great developers from Kansas City, really all across the country. So it's interesting. We drop into new markets and everybody says, man, more Kansas City guys and gals. So we're on the map and well known as a community, which is great. But as I mentioned, we're out of Dallas, Jacksonville, Columbus, and Phoenix. Outside of those markets, we'll travel, whether driving or flying. So we're probably in 60 different townships or cities, all touching office, industrial, some multifamily. Every market's unique. As Jason mentioned, we probably don't have the peaks and valleys like others, but Dallas and Phoenix probably can't say the same thing. We're pretty steady here in the Midwest, which is great. But a lot of good things, a lot of similar things going on. Industrial, minus the different cap rates and maybe construction costs, is really hot, really everywhere. We're doing a project in Des Moines. We're doing stuff in Dallas. We're doing stuff in Vegas, Columbus. I mean, you can't build it quick enough, honestly. And you can't mess up, which is a little scary. So we have to keep our fundamentals on that aspect and product type. But again, office in Texas, Florida, we think it's going to come back strong. We're going to be positioned to take advantage of that. But again, a lot of good stuff really across the country. And Kansas City's getting a great share of that. So.
Great, thanks. And we've got a few additional questions as well that have come from the audience. And Adam, the first one I want to kind of revisit your initial presentation. You did I think a pretty good job of identifying some of the risks that you're looking at between the yield expectations, some interest rate compression, and then on the flip side, the material supply and cap rate demands. And I'm wondering if you can just talk through a little bit about what the interplay is from your view on all those risk factors in the in the next 12 to 18 months. How do how is the bank going to and you're evaluating investments manage underwriting those different risk considerations given the still period of uncertainty that you're facing?
Yeah, sorry, I didn't mean to sound like such a Debbie Downer there. We are excited.
No, that's okay. You're supposed to sprinkle some reality on us as we're talking. So that's okay.
About our growth in 2021 and the great projects that we have in the region. There is going to have to be. I touched on a couple of them in the presentation. I think if you're building your timelines for your construction schedule, you need to build in buffer. You need to build in contingency, you need to build in more interest carry. All that sounds like more equity raise, which, it probably is because you are still capped from a cash flow standpoint or pro forma cash flow standpoint from the lending side of things. I think that here in Kansas City specifically, we're growing as a region and there is great demand for a lot of different asset types. So these projects need to be built. They will be built. Where you flex is I think you've got, I think you've got two prongs there. You've got a lot of institutional money that's finding its way to Kansas City just because of how crazy cap rates have gone on the coast and even Dallas. Grant and I were talking the other day about, seeing 4 caps, like 4 even caps in Dallas, Texas. So, when you look at those returns, Kansas City looks strong. So you've got institutional money that's coming here, and they are okay taking a lower return profile to deploy into quality assets here. So I think that's one change, which is driving a lot of the trading. The other change is that people that are looking for a more solid return are having to try and tackle deals with more hair on them, and they're just having to work harder to try and figure that out. You need partners that are willing to do that. You need a lender that's willing to understand that and work with you on that. And I think, you just flex to try and structure the deal from an equity and a lending side that's going to make things work. And I think if a lot of those factors that are out there, if you're starting to see those in your deals, I think you just need to get with your lender immediately and start saying, hey, I think it's going to be hard for me to get steel or lumber, and we better start talking about what my timeline looks like. If you have a hard stop construction timeline, you need to be working through that.
Okay. Yeah. And that,
I hope I answered that. If not,
no, it does answer it. And I think, that's helpful. And I think Grant had also mentioned, the supply issue, and getting a gauge on that is that's going to be a significant thing, and particularly if you look at a few of the larger regional projects that are taking place, and then look across the country, you can see the impact of that issue. So I think that's fair. We've got another good question that we have a lot of these discussions, and we look at things from a regional perspective and national. But when you get the opportunity to focus on the Kansas City market, there's a lot of interest in the submarkets. So to Grant and then to Adam, are there particular submarkets of the metro that you are most optimistic about, or ones that are causing you to pause a little bit? We would have always talked about, Plaza versus the Loop and the like. But are there particular submarket areas? And Grant, I think this would apply to both the industrial and the office question for you, and then Adam as well.
Sure. So on the industrial side, really, it happened the last couple of years. We have developers in every corner of the city. And so the entire MSA is covered. It feels really healthy. Historically, certain submarkets weren't as robust. 435, I-35, Lenexa, Olathe had a really good stable of existing industrial projects. Obviously, everything in Edgerton with LPKC is great. But you're seeing southeast, northeast, east, west, everybody's kind of covered up with whether build-to-suits or spec development. So a pretty healthy market, in our opinion. On the office side, we at least will still focus on infill sites with amenities, whether, again, parks, walkability, that built-in retail. When we were doing suburban office, it was because it was cost effective and it was truly a race to the bottom in terms of cost and cost for those employees. But now it's, again, a flight to quality and what your neighbors are. So we'll focus on infill, downtown, plaza area, and other unique spots in Kansas City that, again, have that built-in retail and amenity component.
Thanks, Grant. And Adam, how about you? From the lender perspective, you get a real estate opportunity coming in the door. Are there particular KC Metro submarkets that that you'd like to place an emphasis on, or ones that you've got to do a little bit more underwriting to make everything look right?
Yeah, I think we're a regional lender. We want to put out good dollars in any submarket. So we look at each submarket and asset type and market comps for individual submarkets. I'd agree with everything that Grant just said about those. I think some things that'll be interesting to watch are Plaza's undergoing some great change, so it'll be interesting to watch that come back to life. I think that the streetcar, we're already seeing that get torn up, and we're already seeing, major development plays up and down Main Street, Midtown. You've got the Troost corridor that's being resurrected, and it's there's a lot of those interesting things happening within the core. And then you have a lot of growth within our individual quadrants of the city and the outlying cities as well. So no, we're interested in lending in all of those and excited about them.
Great. kind of staying on the submarket question, we had another pop up with a particular question. And Grant, maybe you can take this. If you look at our area north of the river, particularly, and either from an office and an industrial standpoint, and between the investment that's going on at the airport, a lot of the access points and growth that we've seen up there going in through this time, and what I'd say some significant industrial type growth as well from an e-commerce standpoint. Do you have a view on our Northland corridor as it relates from a submarket perspective?
No, and it's probably a submarket I should have touched on earlier. We have a large project on the industrial side we're delivering just east of the airport here in 3 months. It's more likely already accounted for before it's even done. Obviously, the Harley-Davidson plant was purchased by a new owner user, new to the market. We got a brand new airport coming on. There's a lot of good stuff in the Northland and in that corridor specifically. And again, just because of the lack of development land, whether zoned industrial or not, we've all looked across the city and again covered really every corner. And that with the labor pool and access is really primed for a lot of good things to happen in the coming years. And we're pretty bullish on that northwest quadrant.
Great, thanks. And we've got time for one more question, and it is one that I want to direct it at Jason. Jason, you touched on the potential impact of infrastructure funding legislation from the at the federal level, and part of my practice deals with a lot of infrastructure work, and we've had, I would say, several years of a consensus that there needs to be an infrastructure investment, and several years of a consensus that hasn't yet happened. So I won't ask you to prognosticate on whether or not that's going to happen. But the tie-in in this particular one is the part of that infrastructure investment that we've seen and is in part of the Biden plan that has been proposed is recognizing an emphasis on renewable energy, just that energy shift. Our region has got just looking to the west of us, significant growth in wind power and renewables, either from an investment standpoint or an economic shift. When you look at our regional economy, do you have a perspective on that shift to renewables? Is that something we should consider as a potential upside for the regional economy? Is it just unclear now, or does it have some historical reference points that you can see that would indicate what we should expect with that particular growth?
Yeah, sure, Charles. So the energy transition in the United States is just another example of a structural change. And so, we've been seeing this decline in coal-powered electric generation since the early 2000s. And really, it's kind of accelerated over the past several years. Likely this, whatever they're proposing in this bill would likely accelerate that transition even further. And there has been substantial investment in wind, particularly in Kansas, and some extent in Nebraska, but obviously in Oklahoma, Texas, Wyoming, Iowa. Those are the states that people tend to think about that have maybe gained the most from wind power. As a employer, it's not wind power, or even solar power for that matter, is not going to necessarily generate a lot of jobs. There's going to be some jobs in the construction phase of those developments, but when it comes to actually, maintaining those assets, that we know what industry tells us that they don't necessarily employ lots of workers. But certainly the investment itself represents something potentially substantial. But how it, impacts the broader region outside of those spaces is a little bit harder to tell. The other thing to keep in mind is that you also have some assets that are in decline. So what happens to these coal-fired power plants? How are they repurposed? Can they be converted over to natural gas-fired power plants that will likely be an important part of that. But as we saw this past winter with the polar vortex, we need smart grid technology. We need more investments in the grid, because as you put more renewables on, the variability in the grid increases, and then we can get in a situation where we need more electricity fast from a more stable source. So largely, it's going to have to be a broad portfolio of energy investments.
Thanks, Jason. And I'm bothered that we've just run through the whole hour already. Frankly, as much as I enjoyed talking with all of you, the ability to reflect on what we were concerned with and didn't know 12 months ago, to look where we're heading now, and to get the insight of Grant and Adam as far as what you've been able to accomplish during this time is it's a great discussion for all of us, and I think the best part is being able to focus on our region where we're doing that is just a lot of good news and a lot of reasons for optimism going forward. So I want to thank the three of you certainly for giving us this time. I want to thank everyone in the audience as well. We hope this information was helpful to you. I just want to remind you that this has, as I mentioned earlier, been approved for legal education hours. So if you need to report your hours, please remember to click on that CEU icon at the bottom of the screen. And a certificate of attendance, including course numbers, will be emailed to you tomorrow, along with a recording of the webcast. I cannot say thank you enough. Appreciate some great questions and audience participation, as well as the feedback and comments from all three of our panelists. So thank you. And I'll just finish comment is go Royals. Thank you.
Go Royals. Thank you.